Hello and welcome back to the UK Mortgage Market Insights. I'm Craig and this is your weekly roundup of everything happening in the UK mortgage and property market for the weekend in the 10th of April 2026. If you're new here, hit subscribe so you don't miss a thing. And if you've been with me for a while, thanks as always for coming back and supporting the channel. It has been a big week for data, house prices, market activity, swap rates, and a ceasefire that's looking increasingly wobbly. There's a lot to get through, so let's get into it. Starting with lender activity this week, and it's been pretty quiet. A couple of smaller lenders nudged rates down marginally, but there have been no significant rate reductions to shout about. Now, a lot of brokers and content creators have been calling that there will be big rate cuts. You may have seen posts on social media forecasting this based on news that we will come on to. But I want to be straight with you here. Those posts are often more about getting views than giving you accurate, responsible information. The reality is this. You should never be making mortgage decisions based on what someone on the internet thinks rates might do in the future. Your mortgage is one of the biggest financial commitments of your life. It should always be based on your personal circumstances, your needs, and your financial position, not speculation, not predictions, not hope. If you want genuine advice on what's right for you, speak to a professional. That's what we're here for. Now let's talk swap rates, because this is where a lot of what's driving the mortgage market comes from. As of close of business last night, both the 2-year and the 5-year swap rate sit at 4.045%. Now that's down marginally on where they ended last week, but still higher than a month and a year ago. For context, swap rates are what lenders use to price fixed rate mortgages. So when they move, mortgage pricing moves with them. Earlier in the week, there was a brief dip. Now, why would that be, you might ask? Well, because news broke of a potential ceasefire in the Middle East. Markets got a little optimistic, swap rates nudged down. But, and this is a big but, that ceasefire is looking very shaky. And as confidence in it has faded, swap rates have started to climb again. This is exactly why I've been saying for weeks now that geopolitical uncertainty is the dominant force in this market right now. It's not the Bank of England, it's not domestic data, it's what's happening in the Middle East and the knock-on effect on global energy prices, inflation expectations, and ultimately the cost of borrowing. Watch this space very closely. The direction of swap rates in the coming weeks will tell us a lot. Now, there's been nothing major to report on lender criteria changes this week. The market is in a bit of a holding pattern on that front. But I do want to pick up on something that's doing the rounds. Tracker mortgages. There's a lot of chatter at the moment suggesting that tracker mortgages are a no-brainer right now because, well, they're priced lower than most fixed rates. And look, on price alone, they can look very attractive. But attractive is not the same as a right product. Here's my concern. There is talk, and it is only talk, of the Bank of England potentially raising the base rate. Now, personally, I don't believe that's the most likely outcome. Given weak GDP data, sluggish demand, and the current economic environment, I think the bank is far more likely to hold than a hike. But, and this is crucial, my view is not enough of a reason to put you in a product that carries risk. A tracker mortgage means your payments move with the base rate. If the base rate goes up, your payment goes up. And if you can't absorb that, a tracker is not the right product for you, regardless of what I or anyone else thinks about the rate direction. The right product is always the one that fits your circumstances, your income, your outgoings, your risk tolerance, your plans. Don't base your decision on what someone on social media says is a good product choice. Base it on your personal circumstances. Now, the Halifax House Price Index dropped this week, covering March 2026, and house prices fell 0.5%. That follows a modest 0.3 rise in February, and the average property price now stands at just under £300,000. Annual growth has slowed to 0.8%, down from 1.2% the month before, so we're still in positive annual growth territory, but the momentum has clearly eased as we head into the spring. Amanda Bryden at the Halifax pointed directly to the uncertainty around the Middle East conflict as a key factor. Higher energy price concerns push up inflation expectations, which in turn has dampened confidence around interest rate cuts and cooled early year market momentum. Regionally, the picture is really interesting, and it kind of follows what Nationwide said last week. Northern Ireland leads the pack with annual growth of 8.7%, taking the average price there to just under $225,000. Scotland is up 4.4% to $223,000, and the North East has had a strong year too, up 5% to just over £184,000. The Northwest is up 3.1%. But head south and the story flips. The southeast is down 1.9% year on year to just under £384,000. London has fallen 1.2% to £537,000. The regional difference is a really important story. The north is running hot and the south is cooling. Worth bearing in mind if you're thinking about where to buy. Moving on, the Royal Institute of Chartered Surveyors also released their latest residential market survey this week, and it paints a similar picture of a market losing momentum. New buyer inquiries dropped sharply. The balance fell to minus 39% in March from minus 29% in February, the weakest reading since August 2023. Agreed sales slipped to minus 34% from minus 13%. Short-term expectations for sales fell to minus 33%. The headline price balance moved to minus 23%, and near-term price expectations dropped to minus 43%. On supply, new instructions remain subdued, but unsold stock is creeping up, now averaging 47 properties per agent, and that's up from around 45 at the start of the year. Riggs pointed, just as the Halifax did, to the Middle East situation as the primary driver. With average fixed rates climbing back towards 5%, according to some sources, buyer demand has softened. No surprise there. Now here's my take on this, and I've been saying this for a few weeks. Yes, activity is slowing. Yes, prices in some areas are softening. But for the right buyer, this actually is an opportunity. When activity slows, sellers feel it. And when sellers feel it, they're more likely to accept lower offers. We're seeing this with clients right now. This data is confirming what I've been observing on the ground. So what does all of this mean for you? Well, if you're sitting on the fence waiting for the perfect moment, I gently challenge that thinking. The market is giving buyers real leverage right now. Sellers in slower markets accept lower offers. Properties that would have gone for asking price 6 months ago are now negotiating. On the mortgage side, rates haven't crashed. They're unlikely to crash overnight, and if you're waiting for some dramatic drop before you act, you may be waiting for a long time while life moves on around you. So, get your mortgage in principle sorted, know your budget, understand your options, and be ready to move when the right property comes along. Here's my honest take on where we are. The market is uncertain. Swap rates are volatile, house prices are softening in some areas, and activity has slowed. None of that is great headline news, but uncertainty creates opportunity, and I'm a firm believer in that. My message this week is simple. Stay positive, be prepared, and go and grab a bargain. We are seeing this approach work right now with our actual clients. Buyers who have got their ducks in a row, mortgage agreed in principle, solicitor on standby and ready to move, are negotiating hard and they're winning. Even if you're selling and buying, think about it this way. Yes, you might take a slight hit on your sale, but in this market you can negotiate a meaningful discount on what you're buying. Numbers can still add up very much in your favour. And this isn't just a first-time buyer conversation. Although I want to be clear about this, it does remain a brilliant market for first-time buyers right now. There's less competition, more negotiating power, and motivated sellers. But movers, upsizers, and downsizers, this market works for you too if you approach it the right way. So, who specifically should be paying close attention right now? Absolutely first-time buyers. This is as good a window as you've had in a while to get on the ladder with genuine negotiating power. And anyone looking to upsize, if you're buying something significantly more expensive than you're selling, a softening market plays in your favour. Buyers in London and the South East, prices there have actually come back, and you might be able to afford something now that was out of reach 12 months ago. And anyone who is mortgage ready and chain free, you are in the strongest possible position in this market. Sellers love certainty. You can be that certainty. Now, one more thing before I go. If you want to get a real handle on how mortgages work, not just the jargon, but genuinely understanding the process so you can make better decisions, my book, The Smart Mortgage Guide for UK Borrowers, is now available on Amazon, and there is a link in my bio. Whether you're a first-time buyer trying to make sense of it all, or someone who just wants to feel more confident about one of the biggest financial decisions of their life, it's written in plain English. No waffle, no jargon, just plain English. Go take a look. Well, that's it from me this week. As always, if you found this useful, please give it a thumbs up, share it with someone who needs to see it, and if you haven't already, please subscribe. I'll see you next week, so take care.